Demand and supply planning. Today, we'll be demonstrating how we can plan demand and supply planning within the system. To begin, we'll start with demand planning for a finished goods item. As you can see, we already have the actuals loaded for FY24 and FY25. We also have actuals for FY26 up to week 32. Now, we need to plan for week 33 of FY26 through week 32 of FY27. To do this, we have three methods available to us: prediction planning, grid spread, IPM. Let's go through each method one by one, starting with prediction planning. To access this, we navigate to Ops Actions and select Prediction Planning. Here, the system displays the combination for which you'd like to plan. We can select the desired row combination, and then use the Settings button to view the historical data range and the future period. From here, you can make any adjustments needed. Within the prediction settings, you can adjust outliers and fill in missing values as required, and then click Apply. Next, we use the Paste option and select Copy from Prediction, since we're working with prediction planning. We copy the prediction across the full range of future periods, since we're planning for the entire horizon. Once that's done, click Apply, and then save the data. The data has now been saved successfully. Next, let's look at another option, grid spread. Suppose we select a top-level node here, and the data doesn't look quite right. For example, we want to increase or decrease it by 10%. To do this, we select the top level for total customers and navigate to grid spread. From here, you can adjust the numbers up or down by entering a percentage, positive to increase, negative to decrease. For example, if we want to increase the number by 10%, we simply enter a positive 10%. You'll notice the value has updated from 2,425 to 2,667. We then click OK and save the changes. The data is now saved. That's the grid spread method. Next, let's move on to the third option, IPM. To use IPM, we first go to the Configure menu and set up the calendar. Let's navigate to Configure now. From here, we have the option to create a new calendar. First, we set up the calendar and define our events. Within the calendar setup, you're able to define the historical period and the future period. Let's walk through how to create a calendar. I've already created a calendar, so let's open it and walk through the configuration. Here, you'll give the calendar a name and specify which cells the plan applies to. Next, we define the period, that is, which fiscal periods will be used. In this case, we're using FY24, FY25, and part of FY26 as actuals. The remaining months of FY26 and FY27 represent the future period. The current period start defines where the prediction begins, in this case, from week 33 of FY26. For the historical period, we've defined 136 weeks in total, 52 weeks from FY24, 52 weeks from FY25, 32 weeks from FY26. To break that down, 52 plus 52 is 104, plus 32 gives us 136, that's our historical baseline. Next, we define the starting period for the prediction. In this case, we're predicting 52 periods forward, from week 33 of FY26 through week 32 of FY27. Once that's set, we submit it. Once the calendar is created, we move to the Configure step to create a new configuration. I've already created one, so let's open it and walk through the setup. Here, you'll enter the configuration details, such as the name, and select the prediction engine, in this case, Auto Predict, though other options are available depending on your requirements. Next, we select the calendar we created earlier. Once selected, the system automatically pulls in the historical data range and the future data range from that calendar, along with the associated queue. From there, we move to the next step, where we define the members, specifically, which members represent historical data and which represent future data. This is defined at the level 0 descendants of the parent, particularly where there are multiple child members under a single parent. Next, we move on to Model Settings. Within Model Settings, we click Show Events. Here, you can include events. This accounts for occurrences such as major holidays like Christmas or New Year, where sales typically see a spike. If this option isn't enabled, the system will treat those spikes as outliers and exclude them from the prediction. However, if you do include events, the system will factor that seasonal variation into future year predictions as well. Once configured, we save it. This configuration can also be run as a scheduled job through Groovy. We can define the job type and job name to run this via Groovy. I've already created a rule for this. Let's take a look at the demand planning screen, where I've attached this Groovy job to the form. By right-clicking, we have the option to run auto prediction via IPM. Selecting this will automatically generate the future year prediction based on future weekly data using our IPM configuration. That completes the demand planning process. Next, we'll move on to demand of raw item for the corresponding item. So far, we've covered demand planning for the finished goods item. Now we'll plan demand for the associated raw material item. To begin supply planning, we first establish the mapping between the finished goods item and the raw material item, specifically, how much raw material is required to produce 1 unit of the finished good. We can enter that mapping data directly here. We also have a screen for mapping units, specifically, the base unit in which you'd like to place orders. From there, we move to the demand by raw materials review screen. This data is derived from our finished goods demand plan. We also have a screen that shows the raw material requirement for each finished good. The system multiplies these values to calculate demand by raw materials. This data can also be analyzed visually through graphs. We also have a dashboard view where the data is displayed in graph. From there, we move into supply planning. Let me walk you through what supply planning by raw materials means. Next, we define a set of key assumptions, including the demand origin week, safety stock bucket days, reorder multiples, minimum order quantity, maximum order quantity, and lead time. Let's move to the supply planning by raw materials screen. Here, we have on-hand stock, which is pulled directly from the ERP system, along with the open purchase order quantity, which also comes from the ERP. Total demand is pulled from the demand by raw materials review screen, lead time comes from our assumption screen, and the reorder multiple and minimum order quantity are also sourced from assumptions. This gives us the total quantity available to fulfill demand, essentially, the units available at the warehouse, combining on-hand stock and open purchase orders. This total builds up to the demand at the parent level. The demand horizon and safety time settings are also pulled from our assumption screen. Next, we look at the safety stock origin quantity. The safety stock origin quantity is calculated based on the demand horizon. Specifically, it takes the average of the next 10 days of total demand. So, for example, for week 33, it calculates the average of total demand across the following 10 days. That's how it's derived. From there, we calculate the safety stock. We do this by applying a defined percentage to the 10-day total demand summation, a percentage that's entered on the assumption screen. Let me show you that now. You can see we've set safety stock at 20%. As you can see here, our total demand is higher than our total supply, which means we need to place an order to maintain adequate stock levels. Specifically, we are short by 75,556 units, so we need to order that quantity to maintain our stock position and generate a purchase order accordingly. In this case, we'll generate a purchase order for 75,556 units. Similarly, we can review weekly inventory movement and closing units. As shown here, in week 34, a purchase order has been raised for 18,800 units. Now, looking at week 39, we see the required order quantity is also 18,800 units. Since our lead time is 5 weeks, we generate the purchase order 5 weeks in advance. So, to meet the requirement in week 39, the purchase order is generated in week 34, accounting for the 5-week lead time. You can also view this visually through the raw materials graph. Let me show you that graph. This is a sawtooth pattern graph, which shows when our closing inventory approaches or dips below our safety stock threshold. That's when a reorder is triggered. For example, here, at this point, we haven't yet reached the threshold, but as it drops below the safety stock line, an order is placed, and you can see the inventory level rise again as a result. That covers our supply planning process. To start, we calculate revenue, which is derived from the finished goods item, since that's what the company sells. We have wholesale price and retail price available, and here we can select the adopted price. Using a smart list, you can select which price point to adopt, and revenue is calculated accordingly. So, for each week, we take the demand plan and multiply it by the selected price to calculate sales revenue. We also apply a 2% discount rate, so 2% of sales revenue is deducted as our discount. That covers the revenue portion. Now let's move on to COGS. For COGS, since the company purchases raw materials, the cost is calculated based on those raw material items. We have a cost per unit figure for each raw material, along with our demand by BOM data. By multiplying demand by BOM against the cost per unit, we arrive at our COGS calculation. This gives us our weekly COGS figure. We also account for freight cost. Since freight is incurred during transportation, we calculate it as a percentage of sales revenue, which in this case is set at 10%. That percentage is applied accordingly to derive the freight cost. Finally, all of this data flows through to our P&L view, where you can see the various components, COGS, revenue, discount, and freight, culminating in our gross profit calculation. And that concludes our walkthrough of the demand and supply planning process. Thank you.